Welcome to AC Easy, where accounting is explained clearly and simply. Here, you'll find practical tips and tutorials to make learning accounting easy and effective.
So, how do you figure out what something is really worth, years after you first bought it? It's a massive question for any business, especially when we're talking about their most expensive stuff. Today, we're going to pull back the curtain on the accounting rules that make sure companies are being honest about those values. Okay, picture this. A company drops $100,000 on a shiny new machine. It's the absolute workhorse of the factory. But fast forward 5 years. After all that use, all that wear and tear, is it still worth that original price? No way, right? So how in the world do they track that drop in value on their official books? Well, that's exactly the puzzle we're going to solve. In the accounting world, this whole process has a name. It's called subsequent evaluation. Just think of it as the official rulebook for an asset's life after the day it's purchased. It's what makes sure a company's financial reports are grounded in reality, not just wishful thinking. To put it simply, you can't just slap that $100,000 price tag on the books and call it a day, forever. You got to check in, periodically to see if that number still makes sense. Does it actually represent what that machine is contributing to the business? And look, this isn't just some nice-to-have practice. It's a fundamental principle of accounting. Now, here's where it gets interesting. In Canada, businesses actually have a choice to make. There isn't just one single way to solve this valuation puzzle. They have to pick one of two main sets of accounting rules, and that choice sends them down two pretty different roads. So, road number one is called ASPE, which stands for Accounting Standards for Private Enterprises. Think of your local family-owned company. This is probably for them. Road number two is IFRS, or International Financial Reporting Standards. This is the one used by the big public companies, the ones on the stock market. And as you'll see, each road has different rules for dealing with our aging factory machine. All right, let's start with the first and honestly the most common path, especially for those private companies in Canada. This is the cost model. And you can pretty much think of it as the straightforward, just stick to the facts approach. The cost model is, well, exactly what it sounds like. That machine we bought for $100,000, it stays on the books at its historical cost, $100,000. Now, of course, that value is slowly lowered over time to account for it being used. That's called depreciation. But the key thing here is that the value is always based on what you paid for it, not what it might sell for today. It's simple, it's verifiable, it's steady. So the process is super straightforward. Step one, you write down the purchase price. Step two, you only make a big adjustment to that value if something really unexpected and bad happens, like if the machine suddenly becomes obsolete. That's called an impairment loss, and don't worry, we're going to dig into that in just a bit. But hang on, what if sticking to the original price doesn't really tell the whole story? I mean, what if the asset isn't a machine, but a piece of prime real estate that's, say, doubled in value? Well, IFRS has another path for that exact situation. It's a more dynamic, let's reflect the market option. And this is called the revaluation model. So instead of looking backwards to the historical cost, this model looks at right now. It lets a company update an asset's value on the books to whatever it's actually worth on the open market today. This gives you a much more current and sometimes more accurate picture of what the company's assets are truly worth. But you can't just do this willy-nilly. There are some really important rules. First off, this is an IFRS-only game in Canada, so private companies using ASPE are out. And you have to do it regularly. You can't just pick and choose when the market is high. Now, here's the really crucial part. If the asset's value goes up, the company can't just call that profit. It's an unrealized gain, so it gets tucked away in a special account. But if the value goes down, that loss hits the company's profit right away. So whether a company goes with the simple cost model or the more complex revaluation model, both systems have a built-in safety net. It's a mechanism that kicks in when there's a sudden, unexpected drop in an asset's value. This is called impairment. So what exactly is impairment? Well, let's go back to our machine. Imagine it's on the books for, say, $60,000 after a few years of depreciation. But because of some new technology, you could probably only sell it for $30,000, and it's just not generating that much cash anymore. When the value on your books is way higher than what you can realistically get back from it, it's impaired. You're basically overstating its worth, and that's a big no-no. And that's the million-dollar question, right? You can't just guess. Accountants need triggers, clear signals that tell them, hey, stop what you're doing. We need to formally test if this asset is impaired. And honestly, most of these triggers are just common sense. We're talking about really clear signals. You see a giant crack in the machine. That's physical damage. A brand new technology makes yours obsolete. The market value for that type of asset just craters. Or maybe a new law changes the game, even if it's just not performing like you thought it would. Any of these red flags mean it's time to run an impairment test. Okay, so once one of those red flags pops up, you have to actually measure the potential loss. And this is where our two roads, ASP and IFRS, diverge once again. The way they calculate the exact dollar amount of the loss is actually quite different. All right, let's break this table down because the math is what really separates ASPE and IFRS here. Under ASPE, the test is pretty simple. You look at all the future cash the machine is ever going to generate without any fancy discounting. Is that number less than what it's on the books for? If so, boom, it's impaired. IFRS, though, is a bit more generous. It says to look at two things. What could you sell the machine for today? And what's the value it generates from being used? You get to take the higher of those two numbers. So in short, IFRS gives an asset more ways to prove its worth before you have to write it down. But here's the thing that's totally universal. No matter how you calculate it, an impairment loss always ends up in the same spot. It goes straight to the income statement, which reduces the company's profit for that period, and it directly lowers the asset's value on the balance sheet. The books are officially corrected to reflect reality. So why do we have all these incredibly detailed rules? I mean, why does it matter if you use the cost model or the revaluation model, or how exactly you calculate a loss? Well, it all boils down to two words: trust and reliability. So, what are the big takeaways from all this? First, this whole process, subsequent evaluation, exists for one reason: to stop companies from pretending their assets are worth more than they actually are. Second, in Canada, private companies under ASPE generally stick to the simple and steady cost model. Public companies using IFRS, on the other hand, get a choice: stick with the cost model or use the more complex revaluation model. And finally, no matter which path you're on, those impairment rules act like a critical safety valve, protecting the integrity of the whole system.
If you found this video helpful, please consider liking, subscribing, and activating notifications to stay updated with our latest content.